Hey everybody, welcome to our second chapter 3 video. In this video, we're going to use what we learned in video 1 about break even to do some sensitivity analysis. And we're going to do that first for companies that have just a single product, and then we're going to do it for companies that are working with multiple products. Let's get started. So this sensitivity analysis can go by a whole lot of different names depending on the business. Sometimes we call it a what if analysis. Sometimes we just want to compare different alternatives. So regardless of what we call it, the idea is to take information from your base case, your base situation, and then compare change information with a new scenario and see what the outcome is. The idea behind doing this is so that you can see in advance the way things might play out so you can make a better decision about how to spend your time, your money, and your resources. Here we have an example where we have a base current price for a product, and the company is trying to decide whether or not to put a price increase in. This is a really common decision businesses have to make when situations change. If they would like to get more product sales, maybe they are running the risk of running short, their price is too low, whole host of reasons companies might change their prices. But here we have their base case, and we calculate here their break even in their base case. This company at $3.75 sale price, variable cost of $1.50 per unit, and their fixed costs of $2,475 are breaking even at 1,100 units or $4,125. This is literally what we did in the first video, so there's nothing new in this first column. Then all they're doing is saying, but what happens if we increase our price? So they up their price by 50 cents. Everything else stays the same. Economist students might remember the Latin phrase ceteris paribus, right? If all of our other costs stayed the same, but we increased the price, they would break even, obviously much quicker. 900 units instead of 1,100 units, and at a sales volume of 3,825. And at the bottom, we see that contribution margin income statement laid out for both options. This would then give your management team, your leadership, your board, something to look at so they could decide, well, should we do that? And it just gives you the data and the information you need to make an informed decision rather than guessing. And here we have another example. In this case, we see that the price is not changing, but the variable cost is. This might be reflective of something like we are seeing now, where costs of raw materials have gone up. So the variable cost per unit has gone up. This means that the contribution margin per unit goes down. We have less after covering that increased cost to use towards fixed costs, and that variable cost increase means that break even is going to get pushed out a little bit, right? So they're going to have to sell 25 extra units to cover that extra cost or generate an extra, what's that, 25 times $3.75 to make that difference up, right? And in this scenario, they're going to make a little less net income if they're still selling 1,500 units. So you can use this same setup, this same formula to look at revenue changes or look at cost changes. You can also change your fixed costs. So here, as an example, we've left our selling and variable prices the same, but our rent went up. Maybe our taxes have gone up, but we have more fixed costs we have to cover. And so again, just recalculating, you're using the same setup, the same contribution margin, the same break-even formulas, the same contribution margin income statement, and you're just comparing and getting new information from the problem so that you can decide what your business should do and how the situation is likely to turn out. Once you have that single case down, changing just a revenue or just a cost, we can make it more complicated by changing multiple variables at once. So same setup, nothing new here except we see variable costs going down in this example and fixed costs going up. Recalculate, see our new break-even units, our new break-even dollars, our new contribution margin if we're selling 1,500 units, and now you can have that conversation. And there's really no limit to how you might do this. So here we have two different alternate scenarios. We have the current base situation in the first column. We have a situation where the variable cost is decreasing, but the fixed costs are increasing. And then we have a situation where we've taken that decreasing cost, increasing fixed cost information, but also added a price change. So you can try any scenario that your business can dream up. You just want to play it all out and then decide what's in the best interest of your business. So right now, they're still making, in this example, the most amount of net income at their current levels, but if their price and cost information changes, they would be way better off if they can pull it off with their customers to do the 20-cent price increase in the third scenario and make a little bit of extra net income if their customers would allow it. And this is the finesse part. The numbers show you what's likely to happen, and you need to use your own critical thinking and conversation with your leadership team to decide what to do with this information once you have it. So this ends this learning objective with a great little summary slide of what is likely to happen when your environmental situation changes. So for example, if you decide to enact an increase in your selling price, your break-even point will go down because you're getting higher contribution margin and you need fewer sales to break even. This shows you, therefore, what happens if you change your selling price, your variable costs, and your fixed costs. Now we're ready to look at a multi-product situation. The stuff we're learning in this module can actually be used in two different ways. The example we're going to use is how to use this information when you're creating a product bundle. So we're creating a basket of fruit. The basket has 5 apples, 3 oranges, 2 bananas, and a pear in it. The other way you can use this information is to take all of the products that a business has, what we call its product mix. Calculate the ratio of sales for all of those products and then apply this concept to the entire bundle of what a business offers to its customers. Same formulas, different conversation, but still use the same things. When you want to work on a bundle of products, we start with the information that we need that is given to us. So we would begin with the ratio or the number of units in each bundle. So that is our 5:3:2:1 ratio shown in the chart and given to us as a descriptor. We would get the selling price for each unit, the cost per each unit, and then we would multiply number of units times selling price to get the total value of each product in the bundle. For example, there are 5 apples in our fruit basket. Each apple has a selling price of 60 cents. 60 cents times 5, $3. It costs 25 cents an apple in variable cost. 5 times 25 cents gives us a total cost in the basket of $1.25 worth of apples. $3 minus $1.25, $1.75 contribution margin, or is that 35 cents times 5 apples. You do that for each product in the bundle, add those up, and that will give you the total selling price of the bundle, the total cost of the bundle, and the contribution margin. Now, we're making this video in June. It's wedding season. This is the same kind of process that flower bouquets might get made from, or those edible arrangements, if you're thinking about those kind of bundles. Baskets of any type that we might see are made in this way. If I have a full business, a Home Depot full of product, I would look at my total sales, figure out what every single SKU is contributing to my overall store. That would be my number of units. Get all this information for each product, and I could figure out for my store selling prices, total costs, contribution margins, etc. So same ideas applied in a variety of different ways. Here's a chance for you to practice. We've changed the number of units in the basket, so it's a different fruit basket. Go ahead, pause the video, practice calculating the contribution margin. Make sure that you end up at $4.40 and that you understand how to find this for a bundle of product. And then once you've done that, you can check your solutions on the next slide. And here they are. We have 70 cents contribution margin for the apples, $1 for the oranges, $1.50 for the bananas, and $1.20 for the pears, giving us a $4.40 contribution margin overall for the bundle. And once we have this, now we're back to being able to utilize all of our break-even information that we learned in video number 1. Now let's practice it one more time, but having our information presented to us in a different way. So let's look at these next couple of slides for West Brothers. They manufacture and sell 3 types of house siding: restoration vinyl, architectural vinyl, and builder grade vinyl. Each type has its own sales price, variable cost, and contribution margin. So here we have sales price and variable cost for each of the 3 products. Go ahead, calculate contribution margin, and then we'll move to our composite information, our product bundle, on the next slide. And they tell us here that the product mix for West is 5, 3, and 2. So for each 2 square feet of restoration grade siding, they have 3 feet of architectural siding and 5 feet of builder grade siding that they sell. So now this represents that sort of overall sales percentage model. So looking at that in that ratio, just taking a per unit, per bundle calculation, 5 times 625 gives us $31.25 of revenue at the builder grade level. 3 times $7.75 gives us a per unit revenue of $23.25. 2 feet of restoration at $9.25 per unit in the bundle gives us $18.50 in revenue. And that means that the composite unit is $73 of revenue. So if they sell one of each, then they are all bundled at $73 in revenue. Repeat the same thing for variable cost, $42.25 in variable cost. And then we take that information and work through our formulas. So we have a contribution margin for each bundle of $30.75. And now we're back to break even in units. We just then take whatever the business's fixed costs are. Here we've been told they're $145,000. We have $30.75 from each composite unit to cover cost. So at 4,715.45 units, they're going to break even. Now, I would round up, generally speaking, to the next whole unit. So 4,716 composite units, knowing that we're going to have a tiny fraction of a profit beginning at 0.46 on that final unit. Now, this is the new part that we would do additionally when you're working with these product bundles. After you've done the regular break-even formula in units, we need to break that back out to know how many of each individual product we would then need to sell. So these guys actually rounded down to 4,715, but if I need 4,715 composite units, right? Bundle of all of the products. And I need 5 feet, or 5 in my ratio, builder grade sales for each of those. 3 of the architectural and 2 of the restoration. That means I've got to sell 23,577 feet of builder grade, 14,146 feet of architectural grade vinyl, and 9,431 feet of restoration vinyl in order to break even. And so this lets me break out all my units back into the individual products so that I can see how each one is doing. And if you go to any retail store and you see them with their computer software and their handhelds that are really helping them understand what they're doing with each of their products, this is what the software that underlies all of that inventory collection can really do for a business, help them create. So for all of my comp sci people who are thinking about working in the back end of the retail organization, or for my business and accounting folks who are looking at this going, oh, I want to be able to make intelligent decisions at the front end to keep my business flowing, this is where we would use our analysis to make sure that our business is doing well and that we're selling the right combinations and bundles of product to maximize our profit. And now we can end this second video by looking at how that information for a multi-product business shows up on our contribution margin income statement. Here is the sales, right, for each product, the variable costs for each product. We total up the sales, we total up the variable cost, we calculate the contribution margin, and then minus our fixed costs to get to net income. So please notice that even though we've scaled up the complexity of the presentation, all we're doing is utilizing the same layout and providing more additional breakdown. Right? And from our variable vertical analysis, our horizontal analysis, we'd be able to analyze this. Right? I could tell you the fraction of sales from each product. We'd be able to adjust them, right, and answer lots of questions now that we're armed with our ratios and our understanding of these templates and these formulas. And that's really it for this second video. I hope you've found it helpful. Please reach out if you have any questions, and I will see you in our next video to wrap up Chapter 3. Take care, everybody. Bye-bye.